Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition at 2 o'clock of Real Estate 360 that comes to you daily, Monday through Friday at 3 p.m. and Wednesday and Thursday at 2 p.m., along with my co-hosts Joe Kuchera and Laurie Graymont. If you can't make the live show, you can catch your podcast on RE360radio.com and my programs on TomWilsonProperties.com or on iTunes. If you're interested in getting a weekly economic summary, and it's a quick read in about 2 weeks or two minutes, you can go to my website and ask for sign up for that, and you'll get every week a nice summary written by an economist that Sean and I know, who I'll introduce here in a minute. And it will also, you can ask for a report. We have a 19-page report on the methodology of going through and selecting a metro and how to pick the best products to invest in for long-term hold for your retirement or cash flow now. And also, if you have any questions, suggestions for future programs, or any questions that you'd like about real estate investing, please let us know. And we're also would be glad to offer you some free consultation on what direction you'd like to take your real estate investing. We have in studio today special guest Sean O'Toole, who is a self-taught economist. He's an entrepreneur in Silicon Valley. He's an investor who's had a lot of investment experience, hands-on. He's the CEO and founder of ForeclosureRadar and PropertyRadar, and a good friend as well. And we're very glad to welcome him back.
Thanks for having me, Tom.
Nice to have you here, Sean. Today we're going to talk about the dynamic decade of the investor. So we're going to talk about this roller coaster ride that the investor has been on in the last decade, and probably also should say the decade coming up, because in the total history of real estate investing, nothing has quite been like this one. Mm-hmm. And if you're on the bad end of it, it really hurt, but there are opportunities ahead. And if you're on the good end of it, make sure you do some takeaways and don't just assume you were smart, that maybe you were lucky in part, and figure out what you can learn from it and apply that to the future. So we're going to walk through a little bit of what happened. We're going to talk about what the opportunities are for the investor now in this changed world that's somewhat post Great Recession, but certainly not totally out. What are some of the opportunities, and what are some of the tools that you can use to help you be successful? And certainly one of those tools is Sean's company's new product, PropertyRadar, and you will not believe the how feature-rich it is and the number of things that it can help you do much more efficiently and find information that you just can't find or can't pay the time to do on your own. So, Sean, let's just have a little thumbnail sketch so people know what your background is. Backgrounds always impact current thinking and current directions. You started off as a entrepreneur here in Silicon Valley, didn't you?
Yeah, actually, I've had 3 tech startups before I got into real estate investing. The first company called Zing Technology, the first to do streaming video, or the first to stream the Grammys and other things like that on the internet, was purchased by Real Networks. At one of the early hosting companies that hosted Netscape and Playboy and lots of other things, some of the early internet websites. And then at an early software as a service play in workforce management kind of the equivalent of Workday today, but back in the 90s. And that one was actually supposed to go public, and then the dot-com crash happened, and kind of had the rug pulled out from under us.
So what got you into real estate?
So after the dot-com crash, I moved out to my vacation house and was working on my next startup plan for another technology company, and was introduced to somebody who was buying and flipping foreclosures.
And this was back in
2001. Yeah.
Yeah. Flipping foreclosures was not on most people's radar back then.
No, there was probably 40 or 50 guys flipping foreclosures in the state, and the foreclosure volume was down. There was a lot more folks doing it in the 90s, but everybody kind of assumed that the foreclosure thing was over. And and he wanted me to write software to help him better run his business. And I'm like, I'm not writing software for 40 guys. I want to write software for a market of millions, And then he showed me his last 20 deals, and I went, wow, you're doing pretty good. And I'd made some money in tech, and I'm like, maybe I do this for a little while. My wife was pregnant, and I was enjoying my vacation house. And one thing led to another, and I flipped 150 homes.
And that was again back pre your last one was 2005, 6, something like that.
Yeah, I stopped buying at the end of 2005 because I thought the jig was up.
What signal told you that the jig was up?
Well, it was really just what was happening on the street. Every property I was selling was being purchased by I mostly did deals in the Central Valley. So it was a farm worker and a maid, and they're buying a $350,000 house. And I'm just looking at this doesn't work. I don't even want to sell them the house. And, and then I started watching the new home subdivisions, and it went from everything they had was selling instantly to they had to give away a free swimming pool or $20,000 credit or something. And I'm thinking, well, the guy who just bought last week and didn't get the swimming pool had no credit. Right, and is buying that because his buddy bought one last year and it went up $100,000, and that's over.
Big flag. So you made the right call for the right reason, and you saw didn't think foreclosures were going to stop. You thought instead they would probably go up.
Yeah, I actually wanted to be a guy Paulson, Big Short. I wanted to short New Century and Countrywide and all of these companies, and was referred to a friend of a friend who was one of the top brokers to try to place this trade. And he actually happened to be Angelo Mazzillo's broker and some of these other guys, and he talked me out of it. He said, look, these guys are hedged. They're not going to go down. It's all going to be fine. And we've had a couple awkward conversations since, because I would have been done for life had I made the trade I wanted to make.
Wow. Huh. Well, you it was a little bit later that I had the honor of hosting the dinner for you and Bruce Norris, and that was Geraldine Barry was the one who suggested and engineered that get together, and she wasn't available that night, and I had the good fortune and honor of being there and watching you guys become great friends immediately. And I remember when even when I met Bruce in 2005, he was predicting that foreclosures were going to go up by 50,000%. And everybody thought he was crazy, and of course, as it turns out, he was wrong. It went up by more than that.
Yeah, no, Bruce and I instantly bonded because we had come to exactly the same conclusion, but we didn't know each other, and we didn't know that the other was, predicting that. So.
And by the way, Sean now provides a lot of the data that Bruce uses and acknowledges in his presentations and so forth, and they've become great buddies. Talk to us about, so you still thought there was a market for foreclosure information, because foreclosures were certainly going to go up. It's amazing that you did 150 flips when there are virtually no foreclosures. You had to really work hard to find them. But then tell us about the 60 Minutes story briefly coming in town, because I think it's a great story about luck versus opportunity.
Yeah. So
You had the product released.
I had the product released, and keep in mind, my first product was a foreclosure product, but I didn't. I thought foreclosures were going to go way up, no question, but I didn't see that really being a huge opportunity. What I wanted to do was change the way we access real estate. If you look at stocks, bonds, commodities, we get information up to the second. And with real estate, we largely still wait for the industry to self-report. The National Association of Realtors to tell us the number of pending home sales, National Association of Home Builders to tell us, what builders sold. I mean, it's abysmal. And I thought there was an opportunity to provide more real-time data. I already had the data on foreclosures, so that's where I started. But 60 Minutes was really a turning point, and how big the foreclosure thing blew up into kept me on the foreclosure track actually longer than I originally planned. So I had heard that 60 Minutes was working on their first foreclosure story, and that they would be in town and doing filming.
Because Stockton was one of the first epicenters, right?
Yeah. And so I went down and I told the auctioneer, I said, look, let me, if you can get these guys to give me a phone call, right? I've got all this data. I think I can really help them.
You tell these guys I'm the go-to guy for data on this.
I'm the go-to guy. I'll give you $500. And sure enough, he talks them into calling me, and they're very, very skeptical and want nothing to do with me. And I work literally day and night for the next 3 months. If they call it, and they'd call at 11 p.m. and at crazy other times and say, hey, we need a chart. We need we need this information. And I would drop everything and do it. And, so finally at the end, the show's pretty much in the can and it's done. They're going to use one or two of my charts, but, didn't land anything bigger than that. And they're leaving town, and they call the night before they're supposed to leave, and they said, we've gone around and, we keep finding that your information's the best information, and it's super helpful. And Steve Croft has decided he wants to interview you. Can you be here tomorrow? And
let me think about it.
Yep. And so I came out and did the interview. His first question to me is, aren't you one of the investors that caused this crisis? And I calmly said, this crisis happened on Wall Street, not on Main Street. And he smiled, and then we had a great hour-long interview, of which 10 seconds made it into the 60 Minutes episode, but it really launched the company.
Right back in a minute to cap that great story and move on to other things about the investor history and what we can do for new opportunities. We have Sean O'Toole, the CEO and founder of ForeclosureRadar, PropertyRadar, in studio with us today, talking about a lot of great things about real estate investing. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Sean O'Toole, the CEO and founder of ForeclosureRadar and PropertyRadar, in studio with us today. We were talking before the break about how ForeclosureRadar really got launched and exposed by 60 Minutes coming into town. And I think the great takeaway from this is that a lot of people wait for luck to happen, and that you might say it was luck that they came into where Sean was, but he walked through that open door. He did something about it. He incentivized folks to get him connected, and he worked hard to get connected, and indeed they came on the air. But you realized, do I recall correctly from when you've told me the story before, that you realized that it wasn't going to do you a lot good unless you had a lot more server capacity. So you went and shopped around for the best value server capacity you could, and watched the show was airing on the East Coast and watched the lights light up on the servers, right? Yeah,
absolutely. Well, Redfin had just been featured on 60 Minutes, and they'd spent a ridiculous amount of money on server capacity, and they were down for almost the entire show because of the impact that much viewership has on your website. And I knew I couldn't do it with what we currently had. And I actually made the switch to Amazon AWS for the tech folks out there in the crowd, and we were able to scale up and stay live. We had one little tiny blip for just a few seconds, but and our lights lit up, man, when that show aired. And Steve Croft said, if you want to know what's going on in the California foreclosure market, there's only one place to go, ForeclosureRadar.com. Our lights lit up.
Bingo, and the rest is history.
Yep.
That's terrific, and deservingly so. What Sean grasped that opportunity and made the most of it, not just allowed it to happen, I think is the great takeaway from that. So to what degree did investors contribute to the foreclosure, the crash? Do you think?
Yeah, so there's been a lot of talk about that. You look at investor activity, coming into the crash and the rest, and I think very little. Yeah, you certainly had flips going on. You certainly had people making money off of flips.
Pre-construction purchases by people that didn't know about real estate, but it was a tiny piece of the whole picture, wasn't it?
You know what? One of the big surprises of some of the 2010 census data was that, with a few exceptions, in most of the state we didn't overbuild. We've got the growth pretty much to support the housing that we have on the ground here, and if anything, we're underbuilding now. So this whole idea that we so overbuilt now. I think we built too many McMansions out in the cornfields in the Central Valley, that we don't need and that aren't the right product in the right place, for sure. And I think that planning departments have gotten off scot-free because I think they should have been blamed for allowing the wrong product to be built in the wrong places over just greedy city and county councils looking for tax revenue. But the bottom line is we don't have too much housing, and so I don't think that was fundamentally the problem. It was Wall Street.
So we crashed. Didn't happen overnight, but pretty fast. Caught a lot of last greater fools off guard, and folks that thought that they were making money because they were geniuses, not because they were riding the market. Back then, you could buy something if you wanted to flip it and make a zillion mistakes and still come out okay, and you thought you were great.
I always just cracked up because I always had friends coming up to me and telling me what a brilliant remodeler they were and whatever. And, the story typically went like this. They bought a house for $300,000. They put $100,000 into it doing a major remodel and resold it for $500, right? And so they made $100,000 on $100,000, of hard work, and they were in there painting and scraping and worked their butt off for a year. And the reality is, they could have held that house for a year and would have gone from $300,000 to $450,000, and they could have done nothing, and they would have made $50,000 more, and they wouldn't have done any of that work. And so most of the people who thought they were brilliant fixers and flippers from 2000 to 2008 actually, I think, wasted their time, and they thought they were brilliant remodelers, and I think they wasted a lot of effort.
Yep. But they were, and so there were a lot of folks like that. But it was a great ride, and a lot of folks made a lot of money during that time. But unfortunately, many did not prepare for what was around the corner. I certainly felt like it was going to stop. I remember saying to people starting in about 2004 or 5 that I wish this would stop. And they said, "Are you crazy? Why would you do that?" And I said, because, well, I'm watching cycle number 4, and if this goes any farther, we're really going to crash. We have Sean O'Toole, the CEO of PropertyRadar, in the studio with us. This is Tom Wilson, Real Estate 360, KDOW 1220 AM on the Wall Street Business Network. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. In studio today, we have special guest Sean O'Toole, who is a entrepreneur of Silicon Valley, a investor, and a self-taught economist, and also the CEO and founder of ForeclosureRadar and PropertyRadar. So we're talking about the roller coaster ride that the investor has had during this this whole pre and post Great Recession run, what we can take away from it, and where things are going. So what kinds of opportunities do you think the investors have taken advantage of over these past few years since the recession happened, and what has made it difficult for them?
Well, boy, there was a huge opportunity in 2009 to back up the truck, and it was the first time in many years you could buy property that had a good return on investment in California. I mean, one of the things, California's a highly desirable place to be, and that keeps return on investments low, which pushes people to other places like Texas. And so 2009 was a unbelievable opportunity, and that opportunity's slowly gone. Decreased, right? Because as prices have been pushed up, return on investment goes down.
Yep, and that rent ratio is just tough to get anymore.
Well, there's still folks buying, all the time at 7, 8, 9% cap rates. Certainly not in Palo Alto or on the beach in Newport, but we still have lots of places where there's pretty good return on investment. Institutional investors came into the fold in a big way with, large funds, Blackstone and others with, buying tens of thousands of homes and backed up the truck.
And that's the first time institutional investors had ever gone away from grade A commercial and multifamily properties in the real estate arena. It's the first time they really gobbled up large amounts of houses.
And I think it made a lot of sense. The return on investment was fantastic. The other thing about housing versus commercial is commercial properties, in terms of like the credit bubble that we were talking about before, commercial property cap rates, that's the return on investment, vary within a smaller band. But because housing's such an emotional purchase, people will make really ridiculously high purchases on the low end, and then when they go negative on it, they go negative too far the other way. So these swings in residential real estate are much larger, which create opportunity. The buy low, sell high is buy lower, sell higher in residential than it is commercial. Yeah,
the house prices are often driven by owner-occupant emotion and not numbers, whereas commercial and multifam is driven primarily by what the ROI is.
Right, and you still get swings there. What people you get free credit like today, and no place you can't put your money in the bank and get a decent return. That pushes returns lower and lower and lower as people seek yield, and pushes prices up. So there's still swings in commercial, but they're not nearly as large as they are in residential.
Yep. And one of the reasons why I was comfortable with my holdings in Texas were that it's an area that doesn't swing as much, and so it dropped the least of any metro in the United States, according to Case Shiller.
Well, it dropped the least because it went up the least.
Yep. And right. and it still had a relatively strong economy in spite of things that dropped. We'll be back in a moment with Sean O'Toole, the CEO of PropertyRadar and ForeclosureRadar, here in studio with us today. This is KDOW 1220 AM, the Wall Street Business Network. This is Tom Wilson on Real Estate 360. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. In studio today, Sean O'Toole, the CEO and founder of ForeclosureRadar and PropertyRadar, talking to us about the role that this Great Recession roller coasters played with the investor and what kinds of opportunities the investor is able to take advantage of. So there were foreclosures a lot in the beginning, and then there were also short sale opportunities that came along, and some people were chasing pre-foreclosures because it was starting to get hard to get foreclosures, and some people were flipping because again things were starting to climb back up, but they were really good buys. So there was lots of different areas that investors were taking advantage of. Some investors, a lot of investors were shell-shocked, and they just sat on the side watching all of this happen, right? But there are a lot of opportunities.
I don't think they still qualify as an investor if they sat on the side.
How have things changed now over the past few years, now that we have a lot of recovery? Certainly we have areas like Silicon Valley who are back at its prior peaks. And I might point out that I remember seeing an article in Moody's or CNN, I think in 2008 or 9, that said that California would not go return to its prior peak until 2033. So be careful where you get your information, right? We have some pretty interesting quotes from Bernanke and others in the past about
2007, 2 years after I decided to get out of the market, he was still saying that the subprime, crisis was largely contained and there wouldn't be much drop in price.
Yep. I think we both have that on a slide. Certainly Bruce does. Yep. So how has the opportunities shifted, and what are opportunities today?
One of the things you really have to do is divide this up a little bit, because there's radically different types of real estate investors, right? There's the long-term buy and hold investor that's looking for, that has capital that they want to deploy and get a decent return on that capital. So they're kind of yield seeking. You have the flipper that's looking for income, and even that, you can break that flipper down into the wholesaler, which typically is somebody who doesn't have a lot of cash, but they're a bird dog that goes out and finds deals for other people that do have money, and that could either be for a flipper or for a long-term buy and hold person, or they just they focus on buying the property, fixing it up, adding value somehow, and reselling it. And then I would separate out that to the speculator. The speculator buys in the hope that the future market is going to increase the value of the property. And, certainly a lot of speculation going on when you get rapid price increases. And I think we're starting to see some of that back in the market. It's hard to separate out, though, the true investors from the speculators. A speculator can buy at market prices, hoping for prices to go up. A true investor, in my mind, buys below market value by taking advantage of some sort of distress, whether it's buying a foreclosure at auction where you have to come in with cash, you don't get title insurance, you have to evict the owner. It's a messy deal, and you're adding value by cleaning up that property and making it available so that a first-time buyer can come in, because they can't buy a house with cash and without title insurance. And so they make a spread there. So there's lots of different categories of investors, and you kind of need to look at each one independently.
How do you see lending changing for the investor? You and Bruce and Howard and I went back to Fannie Mae and HUD, I believe, in spring of 2011 to help promote. We were invited to come back, and shocked to see there were 16 audience and 6 VPs there to listen to us, and we found that we were largely preaching to the choir. They'd already figured out the investor needed to play a role in helping us solve this problem, but they had a problem with protecting their political capital.
Yeah, no, absolutely. They saw the investor coming back in as the way to go. What they didn't want to do is have an issue where 6 months later there was a story in the Wall Street Journal about how government policy helped investors kick people out of homes, and so that was definitely their struggle with that question.
And I guess part of their solution response to who knows how many people they listened to, like us, but was turning on the hedge funds for some of these purchases.
Yeah, which is unfortunate. It's the world we live in today is a world where, what should have happened in my mind was we make more loans to small mom and pop investors because their ability to get a decent return on capital has been stolen from them, right? You can't put your money in bank and get a decent return, right? You can put it into equities, but it's high risk, I believe. And, real estate's a very safe investment, but by and large, the government's making it illegal for individuals to invest. You have to be an accredited investor to invest in a deed of trust in California. Fannie and Freddie will only make so many loans to small investors. So instead, the spoils all go to very large, very wealthy institutional players. And it's not the 1% getting richer, it's the 0.1%.
To the degree that small investors can get product, you still believe it's a good hedge against inflation?
Absolutely. There's no question in my mind that, real estate is one of the best long-term tools for creating wealth. You have to be smart about where and when you buy, right? Location, and, buying a decent return on investment. If you buy a house with a 1% return on investment based on rents and expect to make it up because of price increases, that you're the greater fool in the greater fool theory.
But if you invest in an asset to a real estate for cash flow, make sure it cash flows now, not on speculation that it may someday.
Yeah, I think that's right. And, and I think the cash flow piece is a little overplayed. There's so many folks out there that say that cash flow is all that matters. I think a good overall return on investment on the property is the most important thing. And then the second most important thing is the cash flow such that you're not caught upside down. And actually, even more important than cash flow is having the reserves to make sure you don't get caught upside down if you lose a tenant for a while.
But don't have negative cash flow in the meantime, if you can help that.
Absolutely.
Yep. We'll be right back with Sean O'Toole for a little wrap-up and talk about PropertyRadar product. This is Tom Wilson with Real Estate 360, KDOW 1220 AM, the Wall Street Business Network, and we'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have Sean O'Toole with us, the founder and CEO of PropertyRadar, formerly ForeclosureRadar, which also is still running. But, so, Sean, there's still a lot of opportunities for investors, aren't there?
Yeah, I think so. There's still, right now, it's possible to buy long-term buy and hold deals in California at reasonable return on investments, right? Okay, maybe not in Palo Alto, but certainly within a couple-hour drive,
and also still in Dallas.
And still in Dallas, yeah. Our service is focused on California, so sorry for leaving Texas out, Tom. But yes, absolutely.
Well, I want you to go nationwide.
Yes, I hear you. And then I think
is that a possibility?
Yeah, it's definitely something we've continued to look at.
Okay,
sure.
We'll root for it. All right. Tell us what PropertyRadar can do to help us.
Yeah, so, for those folks seeking the long-term buy and holds, we'll help you find those areas and those properties that have a decent return on investment. For investors, if you go to any of these real, investing trainings, it all kinds of falls back on some certain activities. Finding folks that are in foreclosure, finding folks that own their house free and clear, finding non-owner occupied properties where the person bought a rental, and some people don't like having rentals after a while, and they get tired and they get a bad tenant and they have a bad experience and they want to sell. And all of those things that all of those real estate gurus teach, you can find those lists using our service. We have over 100 search criteria to help you focus in on those houses that you might have a seller that wants to sell. And of course, we help realtors find short sale opportunities and listings, and just generally help realtors stay smarter than the competition and smarter than their clients, who are now very smart thanks to the Zillows and the Trulias and Realtor.coms of the world. So, that's kind of our goal on that front. And we also try to help folks reduce risk by letting them do really deep research, see what the title history is on the property, what loans are outstanding, how much debt, find out those areas where there's still, we still have parts of California with 30% negative equity. 1 out of 3 homes is underwater. And there's other areas where there's almost none. And you should know which is which
still 1 out
before
of 3.
you invest.
That's amazing. Yep. How can they sign up and what's it cost?
PropertyRadar.com. It starts at $39 a month with discounts for annual prepaid, discounts for California Association of Realtor members. All the features, the top price is $59, so it's pretty inexpensive, and we did that on purpose. We really want to help the small investor compete with the institutional investor. We believe that the government is robbing people of their ability to make a decent return on their money, and we're trying to give people the tools to empower them to find decent returns and fight back.
Thank you for doing that, Sean. It's a great product. I've seen it, and it's just amazing how feature-rich it is and how user-friendly it is. Just even on your smartphone as you're riding around neighborhoods, it's just it maps out what's going on in the area. It's terrific. Sean, thank you so much for being on the program. You're one of my favorite rock stars. You're so generous and humble with information that you give, and all that you've given to folks who need better data to find homes and products. And we look forward to having you back again. If you want to have a weekly summary of what's going on in the world of economics as it applies to real estate, let us know. Go to TomWilsonProperties.com. Again, thank you, Sean. And this is Tom Wilson, Real Estate 360, KDOW 1220 AM, Wall Street Business Network. Remember, what you do next is what's most important.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. AM 1220 KDOW.